Listen carefully, because what I'm about to tell you was not supposed to happen. Not now, not ever. While most of America was asleep, while Europe was just waking up, while Wall Street's machines were running on autopilot, the single most important market on earth went completely silent. For a few seconds, there were no buyers, no bids, no price. And in those seconds, the illusion that has held the global financial system together cracked. Before we go any further, if you want real, no-nonsense breakdowns of what's actually happening to your money, not the fairy tales you hear on TV, subscribe to Capital Pressure right now. Turn on notifications. This channel exists for moments exactly like this. Because last night wasn't a glitch. It wasn't a typo. It wasn't a liquidity hiccup. It was a warning. It's exactly 2:00 a.m. Eastern Time. A massive sell order hit the U.S. Treasury market. Not millions. Not billions. $50 billion of 10-year U.S. government bonds were dumped into the market in one shot. And for 11 seconds, nobody stepped in. Think about that. We are constantly told that U.S. Treasuries are the safest asset in the world, that they are infinitely liquid, that you can sell any amount at any time and the market will absorb it. That belief is the foundation of pensions, banks, governments, and your retirement account. And for 11 seconds, it failed. If you've never worked inside markets, let me explain why this matters. In the world of high-frequency trading, 11 seconds is an eternity. That's not a blink. That's a cardiac arrest. Screens don't just pause like that unless something is deeply wrong. Traders in Asia saw something they're never supposed to see. By wall vanished. The algorithms shut down. The so-called risk-free asset had no price. When trading resumed, yields spiked violently. One move, one tick. A jump so extreme it statistically shouldn't happen during normal conditions. And the media response was immediate. They called it a software issue. They called it a temporary imbalance. They said everything was back to normal. It wasn't, because we know who sold. This wasn't a hedge fund trimming risk. This wasn't a pension rebalancing. This wasn't a mistake. This sale came from Japan, and that changes everything. Japan isn't just another foreign holder. Japan is the backbone of the U.S. debt market. For decades, they have been the most reliable buyer of American government bonds. When others sold, Japan held. When the U.S. needed funding, Japan showed up. They currently hold over $1 trillion in U.S. Treasuries, so when Japan sells aggressively, especially in the dead of night, it's strategic. The timing tells you everything. At 2 a.m. New York time, liquidity is thin, U.S. banks are closed, Europe isn't fully active. If you wanted to minimize damage, you would sell during peak hours. Selling at 2 a.m. does the opposite. It maximizes impact. It sends a message. And the message was this: Japan chose itself over the U.S. bond market. Here's why. Japan is under extreme pressure. Their currency, the yen, has been collapsing. Every tick lower makes energy more expensive, food more expensive, political pressure more intense. At a certain point, defending your currency becomes a survival decision. To defend the yen, Japan had to buy yen. To buy yen, they had to sell dollars. And the largest pile of dollars they own is U.S. Treasuries. So they sold, sacrificed bond stability to save their currency, and it worked briefly. The yen strengthened. Tokyo stabilized. But the shockwave didn't stop there, because buried inside this move is a much bigger problem, one almost nobody is talking about: the carry trade. For years, global investors borrowed Japanese yen at near zero interest rates, free money, converted it into dollars and bought us assets, stocks, bonds, crypto, real estate. That cheap yen helped inflate everything: tech stocks, AI stocks, Bitcoin, real estate. But this trade only works if the yen stays weak. The moment the yen strengthens, the math breaks. And last night, the math broke. When supply overwhelms demand, prices collapse. When bond prices collapse, yields explode. At 6%, 7%. The math stops working. Interest payments alone would consume nearly half of U.S. tax revenue. That's not sustainable. It's not theoretical. That's arithmetic. At that point, the Fed faces a choice: let rates rise and crash the system, or print and destroy the currency. History tells us what they'll choose: printing, which means dilution, inflation, loss of purchasing power. Japan knows this. That's why they're acting now. So what do you do? First, engagement matters here. This is making sense so far? Hit like, share this video, and comment "I'm watching" below. It tells the algorithm this conversation matters. Second, you rethink what safe means. Long-term bonds are no longer protection. They are exposure. Liquidity matters. Flexibility matters. And assets that can't be printed matter. This isn't about fear. It's about positioning. Because the world is shifting, quietly, structurally, mathematically. And moments like last night don't come with sirens. They come with silence. 11 seconds of silence. That told the truth. Japan showed its hand. Question is, will you recognize the signal or ignore it until it's too late? This is capital pressure. Stay sharp. Stay prepared. I'll see you in the next breakdown.